Hey folks, welcome back to the channel. This is Jason, host of Fighting Words Financial. Let's talk a little bit about markets today. Let's talk about some very interesting things happening right now. Folks are starting to mention the word capitulation. And if you don't know what capitulation means, that's basically when retail investors sort of give up on the market, despair sets in, and that's when we hit sort of rock bottom. So just a couple of days ago, there were a bunch of articles out saying that the retail investor has not hit the point of capitulation. But JP Morgan recently came out with an article that runs kind of counter to that. And let's take a look a little bit at some of the news here, and let's talk about what you guys think about where the market is heading. I'm going to lay things out here. I don't really like making predictions, but these are the times where you kind of need someone to make a prediction for you. I think that we're pretty close to the bottom right now, right? I think that the bottom for the S&P is probably right around 3,600, within 10% of that, right? So 10% of that 3,600 number would be sort of a normalized end of the credit cycle. And I said this before, where there was an inversion in the last run up in the stock market where price to earnings ratios expanded, and that accounted for about 70% of the run up in the market, where typically that only accounts for about 30%. And earnings growth in earnings actually accounts for 70%. Those numbers were inverted this time around. If we kind of do the backwards calculation, fair market value for the top of this credit cycle, let's say January this year, would have been about 3,600. So I say we see possibly a 10% decline from that number. I say that almost all of that probably happens before the end of August. We will still be if we are in a recession now, which it's likely that we are. Remember, the textbook definition of a recession is 3/4 of consecutive contraction in GDP. If we are in a textbook or a recession right now, I fully expect us to be in textbook recession until the end of the year, and yet we'll probably see a new bull market emerge long before the recession ends, as that is typically what happens. Okay. So a little bit about markets today. Looks like markets are just closing right now. NASDAQ 100 up 208, about 1.8%. We are seeing further deterioration in energy. Energy now is only up about 29.83% for the year. That is the only asset class that is up. But consumer staples, utilities, and healthcare have seen a little bit of a turnaround in the last couple of days, and they are trending up. The S&P 500 was up 39 points today, or about 1.1%. The Russell 2000 up 1.93, 1.2%. And the Dow Jones is up 197 points, or 0.6%. Remember, the sort of the least accurate of all of those as an indication as to what's happening with the stock market in general is the Dow Jones Industrials. That is only 30 stocks at this point. In our minds, though, if you started investing a long time ago, or if all you watch is is financial media and you don't really educate yourself on the stock market, you may think that the Dow Jones is really sort of the bellwether for the stock market. It's really not. The S&P 500 probably a better measure of that. So Florian Vravi says Christmas rally. No, Florian, the rally comes far earlier than Christmas, in my opinion. Like I said, the stock market will improve long before the economy actually does. Look 3 to 6 months before we see a turnaround in the economy. And once again, we see positive growth over 1% GDP growth. We'll see the stock market turn around long before that, because the stock market is a forward pricing mechanism for the economy. It's always looking 6, 9, 12 months into the future. So, honestly, let's take a look at this article. It's really short. JP Morgan says that retail investors are finally bailing on stocks. So why is this a good thing? It means that we're close to that point of capitulation where everyone gives up, and that's kind of when the market kind of turns around. So some of the last bulls of the party are finally yielding to the bear market, bailing from stocks at the fastest rate in nearly 2 years. Retail investors who'd almost always bought the dip since the pandemic crash exited shares in the past week, with sales reaching the heaviest since September 2020, according to estimates by JP Morgan Chase and Company, based on public data exchanges, right? So this is just based on data. This is not an opinion of JP Morgan. That's going to be based on the hard evidence that's out there. The exodus marks a notable shift for small-time traders who mostly hung on during the $15 trillion sell-off this year. Sentiment is finally cratering, with losses piling up in their favorite stocks as well as cryptocurrencies, says JP Morgan strategist Peng Cheng. there's been a trend of weakening demand. He said in the interview, and it's fair to say that retail has capitulated. Just a few days ago, this was not the case. There weren't a lot of people saying that that retail has cratered. So the disaffection is welcome news to market watchers who focus on cathartic selling, saying that they would indicate that the downward trend has reached its bottom. I'm not sure that it's reached its bottom. I'm saying that at this point, every sign, though, says that we're going to reach that bottom before the end of August at this point. There's a few sort of positive things that happen at the end of August. Anyway, we see some demand destruction for gasoline. We see an expiration of oil futures contracts, and we see delivery of oil futures contracts. That's when we're going to see a lot of the pressure being taken off supply chains here. So a lot of professional investors have slashed their quality exposure, their equity exposure to multi-year lows. Now the day trader army is joining the crowd of bears after spending money many months clashing with pros. Not that gambler spirits have been snuffed out entirely among the retail crowd, many of them who cut their teeth investing during lockdown. So so the article makes this point, and they should always make this point, is that that the retail investor was a significant driver of inflated valuations that we saw in tech and crypto. The reality is retail tends to buy the most at the top and the least at the bottom. We've seen this before in pretty much every market cycle, including the dot-com crash. So in one respect, that is one thing about this economic cycle that is actually absolutely the same as every other economic cycle. The retail investor is always last of the party, buying the most at the top, buying the least at the bottom. Now is when you should be making purchases. Between now and whenever the market actually does turn around is when you should be making the vast majority of your purchases. So, and if we look at other financial news that's out there, everything being negative right now can actually be viewed as a positive. I've been talking for a few weeks now about the earnings recession that is coming, meaning that we're actually going to see a decline in earnings. Most of that is going to be driven by an increase in bottom line expenses for companies, and there's going to be a delay in passing that on to the consumer, and it's going to eat into their profits. So evidence is building that Wall Street is going to have to scale back its forecast for corporate profits. This could drag the market even down even further. Like I said at the beginning of the cast here, I don't think that it gets too much below 3,600, maybe about 10%. Also, there are signs that what the Fed is doing is working. Companies are borrowing less. The Fed is getting exactly what it wants. That is what the Fed. That is the Fed's aim when they, of course, raise interest rates. Is they want to tamp down on borrowing. They want folks, especially companies, to be able to borrow a lot less. Not necessarily individuals, but they definitely want companies to borrow a lot less, and they don't want it to cost them a lot more. This is a Barron's article behind their paywall, and it says that the Federal Reserve is getting exactly what it wanted when it lifted interest rates. Less borrowing by companies, a lot less. So far this week, for example, not a single company has borrowed money according to data from Bank of America. What? Okay. Not a single company has borrowed money according to the data from Bank of America. Companies really started to back off their borrowing a little over a month ago, not long after the Fed set out on its path to increase rates to tame inflation. The central bank raised the benchmark lending rate a quarter point in March and then half a point in May. And another one is right around the corner, more than likely another half point increase, although the speculation could sign off on 3/4 point hike on its meeting Wednesday, which it did, by the way. That's already in the past. That already happened. Something that the higher lending rate does is push up rates on household and corporate bonds. Household bonds are borrowings by a person, say a car loan or mortgage, and corporate bonds are one way that businesses borrow for their projects or finance debt. Companies issue bonds which are sold to lenders to raise capital. Oh, okay. This is what they mean by companies not borrowing money. There weren't any new bond issues. It wasn't that they weren't using lines of credit or something like that. So, okay. All right. So companies are issuing fewer bonds this week. Not even one corporate bond has been issued. Okay. Very different than them not being able to get lines of credit or something like that. That would indicate frozen credit markets. Not surprising. It's not that bonds aren't going to be issued here in the future. They will be. It's probably just going to take a little bit of getting used to for companies to have to issue bonds again, where they actually have to pay higher coupon interest rates. So Companies raised just under about $2 billion in new high yield debt a week in the past 6 weeks. That's down from about $5 billion weekly average earlier this year, and a multi-decade high of about $13 billion in April of 2021. So high yield debt is, of course, junk bonds. It's the new way. It's a new way we call bonds that are not really investment quality, meaning you couldn't put them in a bond fund and call it like a quality bond fund or something like that. So so this headline is probably not as alarming um, as it would appear to at the very beginning. So let's take a look at one or two comments here. Demos says, do you manage your own rental properties or pay a management company? So in the past, in the properties that I own out of state, I have paid a management company. But I'm fortunate in that I've got some really good long-term tenants in my residence and all of my properties right now. So I don't pay a management company anymore. Management company was really for me about selection of good tenants when I was managing things remotely. It's very hard for me to do that, to interview those people. Of course, I can run credit on them. I can use some of the tools that actual professional management companies use. But no, at this point, I don't. And especially if you live in a high dollar market where, say, there's a huge difference between inland rental prices and rental prices near the ocean, and the management company always charges 8% or always charges 10%, you start to really resent that 8% per month on $3,000 rent versus that 8% per month on $1,000 rent for a property that's 20 miles inland. I think that there's no extra work involved for managing a property that rents for $3,000 versus managing a property that rents for $1,000. The only difference is better location and so you can charge higher rent. And I really started to resent those high management fees. And it really does eat into your return over time. It eats into what you can reinvest in the property. Although having a bad tenant can cost you a lot more money than a property rental company will over the useful lifetime of that property. I had one property that had $34,000 worth of damage in it that needed to be repaired. And that's after I did a lot of the work repairing it. So that is something you'll have to think of yourself. If you live close enough to manage it without a problem, then you may not want to use a management company at all. If it's out of state, I think you may want to consider a management company, at least until you can get a long-term resident that's in there. So let's talk about Neo. Steven says, let's talk about Neo. And then George follows up with a question: why am I not focusing on BYD instead? Okay, let's talk about both of those actually. The only reason I haven't covered Neo and BYD recently is because for a long time that seemed to be all that I covered on my channel. And as a financial professional, I didn't want it to seem like my channel was just about EVs. That just happened to be what I was really interested in at the beginning when I started this channel. And that happens to be what I covered all the time. I'm really invested in tech investing, but the reality is my expertise is a lot broader than that. But let's talk about Neo. Neo has never been fairly valued, meaning that it's always been a bit overvalued in terms of its actual current earnings, overvalued in terms of its actual projected growth, maybe not its growth prospects, but definitely its projected growth. When I look at realistically how much of the domestic market Neo could possibly capture and how well they can probably do internationally, they probably needed to get beat up just a little bit right now. And they're approaching right now. Essentially when they hit $14 a share earlier this year, if I didn't own so much Neo, I would have acquired more then. At anywhere under $30 a share, if your time horizon is 5 years or more, I think it's a stellar acquisition, a stellar thing to put in your portfolio, as long as it isn't overbalancing, meaning you have too much in EVs or too much in a single stock. I think on a 5-year, 10-year basis, Neo is set up really well to grow. They're investing a lot of money into R&D. They have a strategy that I don't necessarily agree with, but it doesn't mean and this is what I'm talking about with battery swap. I don't necessarily agree with it, but I actually think it's doing a really good job of overcoming range anxiety for a lot of people. all of the things that the negative things you hear about it in other media sources about, oh, there being an hour wait long to do battery swap in certain cities. Yes, that's going to happen. Those are growing pains. I never saw battery swap as really a permanent part of NEO's strategy. It's really a bridging strategy to get over range anxiety. And as we have better infrastructure, charging infrastructure, not just in China, but worldwide, and as we see battery technology improve, I think that the need for battery swap is really going to decrease. Where, in the future, every bit of new construction that happens is going to have charging stations, that sort of thing. But George is right. In a lot of ways, we should be focusing on BYD. So, and let me highlight your comment here. In a lot of ways, we really should be focusing on BYD. BYD is the one company out there that I've covered quite a bit on my channel, and it gets a lot of views. For some reason, the advertising dollars on those are really, really low, and I think it's because it's just not popular here in the U.S. It's not traded on. It's not traded, on the New York Stock Exchange or the Nasdaq. It's over the counter, but it is literally one of the most important companies in the world. They've got more than 250,000 employees worldwide. I think they operate in 25, 30 different countries. They have manufacturing facilities here in the U.S. They're selling a lot of buses here. They're selling a lot of industrial equipment here. And their EV fleet in China has surpassed sales of Tesla at this point. And they're really doing that by focusing a little bit more on that lower end of the market, what we think of as the lower end of the market. You hear this constant refrain when people talk about the middle class in China. The middle class in China is larger than the entire population of the United States. The majority of people in that middle class in China, we probably would not call middle class here in the United States, right? And in fact, a lot of people we call middle class here in the United States, I wouldn't class them as middle class either. I think that the way almost everyone in the United States either defines themselves as lower middle class or upper middle class is part of the giant snow job that the elites have pulled on the population here in the United States, and it's part of class warfare. In China, though, when you're looking at the class structure, a vast slice of the population of that 300 million or so that is supposedly middle class in China, they're never going to be able to afford a Tesla. They're never going to be able to afford a Neo or an XBON. Even a $25,000 vehicle is really out of reach for them. So a lot of the families that are considered middle class are actually pretty good with money. They're able to save, and they're not going to spend that much money on a car unless they can really afford it. BYD has taken this different route where they have their SUV available at about $17,000. They have the BYD Dolphin available at their base model, which gets like 210 miles range. It's a 4-seat vehicle. They have one designed specifically for the taxi market. It's about 210 miles of range, $12,000, right? So, and we've seen this in the past, and I think they looked at like the Wuling Mini, which was a vehicle that is produced in collaboration with GM. At one point, they were selling 40 or 50,000 units per month of that little tiny electric vehicle that gets about 100 miles per charge, and it's a 2-seater. It could carry basically 2 people and some groceries, and that's about it. But at one point, that was a best-selling electric vehicle in China. I think that BYD kind of took their cues there and recognized that there was a giant, really broad market of people that needed an entry level electric vehicle because there are a number of economic incentives for owning an electric vehicle in China. The first of them being that you don't have to buy a license plate. I know that sounds strange. Like, what does the license plate cost you in the United States? Virtually nothing. Well, in many of the major cities in China, you have to buy that license plate at an auction. It's going to go for somewhere between $12,000 and $15,000. I'm not kidding. And you can go to auction many, many times, and you're not assured to actually win one of those license plates at auction. It's that hard to get one for an internal combustion engine vehicle. If you buy an electric vehicle, there are no fees for registering your vehicle, for getting a license plate in many major cities. Also, there are subsidies for vehicles that are under a certain price point as well, which those really inexpensive $12,000 vehicles are going to qualify for that full subsidy. So there are a lot of things going on that are propelling that China, in terms of market adoption of electric vehicles, China is vastly outpacing the United States. They bought a lot more electric vehicles last year. They're going to buy virtually twice as many as the United States is buying this year. So when you look at like advancements in markets, you really have to say that market wise, China is leading the way in the EV revolution right now. Technology wise, you'd still say that Tesla has that edge. That edge is not going to last forever, folks. It really isn't. I know people keep talking about the data, but a lot of other companies are gathering data at this point. So Stephen Kua asks this question. So do you think that XBON is a better company than Neo? Well, you basically just asked me to compare religions. So it's not quite as bad as it was last year, but last year, basically, if you said anything about Neo, it was almost seen as sacrilege. If you said anything against it, um, I do think XBON is a better run company than Neo. I think that they build factories better. I think that they've done a better job of managing their company build out. I do think that, however, this year they're caught a little bit by bad timing. Their next factory won't be completed till December. They're pretty much stuck at 20,000 units in production, right around 20,000 units in production till the end of the year. Their next factory, best case scenario, comes online after that December one comes online April. That still only gives them a total production capacity of about 400,000 units per year. And relatively pretty, and they won't scale up to that immediately. So it'll probably be end of next year before they hit the production capacity of roughly 400,000 units. So they are limited by how much they produce. They can sell everything they produce right now. They can't produce it fast enough, right? Having said that, they're in really good financial condition in terms of debt. They're in really good condition in terms of how the company is structured and owned, and they're spending a lot of money on research. So last year, I would have definitely said XBON was a better company, despite the press that was out there. Neo, however, I want to see how fast they can scale up production in Neo Park. They were supposed to be in production already. I haven't gotten a ton of updates on what's going on with Neo Park. Um, yeah, I haven't gotten a ton of updates on what's going on with Neo Park, but they're supposed to already be in production. By the time Neo Park is finished and up to full scale production, Neo should have capacity with all of the different manufacturing facilities of about 650 to 680,000 units per year. And they're going to hit that before XPeng does. The differences, of course, is the rather onerous relationship that they have with JAC Motors, where they pay a per vehicle fee that's relatively high and didn't get, it's estimated to be about $2,500 per vehicle, right? So we don't know exactly what it is, but I've done some math on there, and there's another YouTuber that kind of did the same thing. And I came up with about a $2,500 figure. He came up with a little bit more than that. But that's what I think that they're paying in a per vehicle manufacturing fee to JAC. JAC is a third-rate state-owned manufacturer, and the majority of expertise here is probably coming from Neo's engineers. But yes, I do think that XBON in the long run is probably a better company than Neo for a couple of different reasons. Their starting point for their target market is just much broader, right? They didn't target basically Neo's is a carbon copy of Tesla's strategy, right? XPeng sort of ended the market saying that Tesla's already done a lot of the heavy lifting in terms of making people aware of electric vehicles, making them cool and making people want them. We want to attack that broader market where we can take a higher volume and lower margin unit and just sell the crap out of a lot of them and sort of dominate in that space. And they've immediately also gone out and they've hit the right price points in foreign markets as well. So I really expect it in the long run to see Neo only be limited, not Neo rather, but to see XBON only be limited by how fast they can expand, right? And that's the real key. Are they going to be able to manage expansion effectively? So Demo says, will high gas prices accelerate EV adoption, or are they still too expensive? I would say that in the markets where gas prices are higher anyway, which is like Washington area, California, we're already seeing EV adoption to the point where it's no longer a doubt whether or not EVs are going to eventually take over the market. It's almost a certainty at this point. Satisfaction with EV drivers is exceptionally high in markets like California and Washington. And a lot of it has to do with the fact that you're just not hassled by things. These are folks that probably aren't driving more than 250 miles in a day. They're probably not driving more than 100 miles in a day. You're going to leave your home with your car fully charged. You're never going to need to go to the gas station. You don't need to go to a charging station unless you're driving to Vegas or something like that. And when you go to the supercharging station, you stop and get a hamburger or two or whatever it is you're going to do there, right? The cost of ownership of a Tesla Model 3 is roughly comparable to that of a Toyota Camry at this point. I think it may actually be a little bit lower than the Toyota Camry, largely because you're doing a lot less in the way of maintenance. But for a lot of folks that live in California, remember, I think something like 32% of homes here have solar. Maybe not enough solar to power an electric vehicle as well. But I personally, when I put an electric vehicle in my lineup of cars here, I'm going to drive that baby for free because I've got enough solar to basically drive 1,000 miles a month, as well as power all of my electrical needs by adding 4 panels onto my house. Adding 4 panels onto my house is going to cost me under $2,000. You better bet I'm going to buy that Tesla or whatever it is that I end up buying, put the extra 4 panels on my house and drive for free and get my electricity for free. That I think that's going to be one of the biggest drivers of adoption, is going to be the fact that it happens here in the West. Everything automotive, and I know people hate to hear this, but everything automotive pretty much happens here in California first and spreads to the rest of the country, and everyone else gets dragged kicking and screaming into the modern era, whether that is new car designs, new electronics in cars, regulations for environmental regulations on vehicles, efficiency standards, whatever it is. It happens here first and spreads to the rest of the country, right? And that's just because this is one of the markets most likely to adopt new things. There's nothing special about California by itself. It's just this market is always ready to adopt new things. But high gas prices, Chris, I don't expect high gas prices to last forever. And we talked about this before. The oil industry, because it's so globalized and because oil is tied into national interests in a lot of cases, there are a lot of foreign governments that have nationalized oil, and they are dependent on oil production to basically satisfy to make good on all the promises they made to their populations. We're going to see a pretty large crawdad effect after futures contracts expire in August, where countries are going to start, OPEC countries are going to start producing more than they say they're producing. Non-OPEC countries are going to start flooding the market with oil. And the only thing preventing a crash in oil right now is, I think, is actually the sanctions on Russia, right? I think that's pretty much the only thing that's doing that. Their aim, if you remember, in 2021 was to actually get rid of U.S. shale producers in the market. They wanted to take away market share of U.S. shale producers in the United States because they were disrupting world markets. That was the stated aim of Russia in February and March of 2020. All through 2021, the stated aim was, we want U.S. shale producers to have less market share. They started over pumping literally to make our companies go out of business or at least stop drilling, which is just part of the game. And that happens all the time in the oil industry. It's cyclical in that way. And companies play national politics in that manner. Our companies don't have the ability to do that because we don't have coordinated energy policy. We never really have, because we exist in a more capitalist system than a lot of these nationalized industries do, right? So, no administration can go to the American drillers and say, I want you to drill more and pump more oil. Well, they're responsible to their shareholders not to, and I mean, short of invoking the War Powers Act, they can't do that. Those companies are responsible to their shareholders, not to any administration here that's ever elected. There are, of course, laws and policies that could be passed to incentivize drilling, or to incentivize more production or to incentivize more pumping. That's never really worked. It's been market forces that do that. So, and if you paid attention to my live stream yesterday, where I showed the numbers that Baker Hughes put out, the United States has added, we're at about 740 active drilling rigs in the United States. That's added about 270 for the year, basically a 50% rise in drilling rigs just in the last 12 months. Canada's like 157 or something like that. They've added 43 rigs. That's about a 30% gain for 30 or 40% gain for them as well. So between the United States and Canada, that actually makes up more than half of the active drilling rigs on the entire planet right now. It's not the United States and Canada that aren't pumping enough. It's the rest of the world. They've not even begun to start pumping. They will. And they're going to be adding active rigs, especially when they see how much market share Canadian oil companies and U.S. oil companies are taking. And especially when they see that some of that market share internationally is up for grabs too, now that Russian oil has become a lot more expensive. It's taking it a lot longer to hit the market. It's doing it in a manner that's either going to India directly or it's going to go to the market indirectly, and it's going to add cost. So all this shakes out sometime after the end of August, right? Which is kind of positive news. The idea that we're going to have the gas tax holiday, it's only 18 cents per gallon, guys. I realize that could probably make a difference in somebody's life. It will not make a difference in the overall price of oil. It is a gimmick. Obama was right when he called it a gimmick. The Republicans are also right when they call it a gimmick. It is a gimmick. It is something that makes you feel better, that materially won't make a difference to the price of oil. So I think that is something that it should be viewed as a positive. No one thing is going to bring the price of oil down. No one thing is going to bring inflation down. There are lots of things that have to happen in order for inflation and the price of oil to come down. So feel free to ask questions, guys. Just wanted to remind you, of course, that the super chat features are on. If you've never used those, I don't actually know how to use them. But yeah, ask any questions you like. I'm happy to talk about anything related to financial markets. So this is an interesting article that was put out on Barron's today talking about the crypto crash. The cryptocurrency crash could lead to a wave of M&A, meaning mergers and acquisitions. So the downturn in cryptocurrencies is expected to fuel a wave of consolidation in the crypto sector in the second half of this year. Is that a good thing or is that a bad thing for the crypto sector to be consolidated? Do we need consolidation? Kind of creates de facto regulation in a way. It limits a lot of ideas. I'm not sure that crypto is really ready for that right now. I would like to see a lot of these new cryptocurrencies disappear and go away, though. A lot of them are nothing more than cynical money grabs. But in terms of actual companies that are developing real projects, I'm not sure that I really want to see consolidation at this point. But yeah, so crypto mergers represent a tiny chunk of the overall deal market. We're probably looking at a giant wave of M&A anyway, where companies that are flush with cash are going to be looking at companies that are maybe a little bit distressed right now, and they're probably going to see some opportunity there. So let me see here. Russia reduced gas supply to EU this week and silently threatens to cut off supply entirely next winter. Also, wheat reserves are not enough. So the wheat crisis is the crisis that only lasts for a single year. The ability for the rest of the world to step up wheat production is there. We need to shift manufacturing of fertilizer to a few other places. It is concerning this year. We are going to see a food crisis of some sort, probably beginning in the wintertime when both Russia and Ukraine have really bad harvests, right? And we don't have enough in the way of wheat reserve, particularly in the Middle East. Especially, we've also seen bad harvests in Syria for years. We've seen declining harvests in Egypt for basically a generation at this point. But the United States is still able to produce tons and tons of wheat. We have tons of excess corn. We could end up becoming sort of the breadbasket for the world in this case. So hold on a second here. But there's another thing that is threatening the gas supply for the EU, and that is actually Ukraine. Last night and the night before, they ended up hitting some oil refining operations, and they did end up shutting off some gas exportation to and GoPlats or oil and gas platforms in the Black Sea. They hit those with some anti-ship missiles. So two things could be going on here. Number one, those platforms were stolen from Ukraine after 2014 and just co-opted by the Russians. I think it's a fair thing to make them a target in war. But I think also that Ukraine is sending a signal to the rest of the EU. There's been a lot of promises of weapons and arms deliveries to Ukraine that haven't happened yet. It's kind of like they don't want the Russians to win, but they don't want the Ukrainians to win either and embarrass the Russians. And I think that Ukrainians are sort of subtly sending them a message here that this is total war and that they want to win, and they're going to use any means necessary to do that. And the number one means they could do that is to cut Russia off from selling oil, to cut Russia off from selling natural gas to Europe, and that is going to affect their ability to wage war and their ability to actually raise money to wage war. So, yeah, I do think that Russia cutting off their gas supply and threatening to cut it off entirely next winter, the world isn't sitting on their hands. They see this as an opportunity to sell them more natural gas. I would imagine that liquid natural gas tankers, there have been a few of them produced. I imagine that they're producing them like crazy right now all across the world. I know that the UAE is making plans to deliver natural gas. I know the United States is making plans to deliver natural gas to Europe. It's probably not going to be enough, and it's going to be a tough winter in Europe. So, and George says, it makes me think the macro environment is far from being better than today. Yes and no. We'll have to think about that. And like I said, the stock market and the macro environment are not the same. The stock market is a forward pricing mechanism. Long before the macro environment improves, you're going to see the stock market improve. So, you spoke about cybersecurity companies to buy. Have you looked at Fortinet? I have not. And actually, when it comes to cybersecurity companies, I'll be honest with you, I'm pretty weak on my research in those. I really just started looking at those as really viable investment opportunities, and largely because understanding the differences between the technologies, what they're targeting, has been a little bit more difficult for me than it has been in the past. I've had to do a little bit more deeper research in this. So, no, I haven't looked at that company just yet. And looking at this in the context of cloud computing too, how authentication is done, what's likely to change in the future, what the potential threats are, that's all getting more and more difficult. Like, I'm actually probably going to end up paying for a consultant to come and actually talk to me about that, largely because I think I'm a little bit outdated at this point. My knowledge in that sector is probably a little bit outdated, and I need a refresher, and I need to be educated on that myself. And I have to be in order to make good investments in that area. I feel like that is an area that I'd like to have a concentrated bet in. There are a lot of sectors of the economy that I'm happy to hold just in an ETF. Just say, hey, I've got it covered with an S&P 500 fund, largely because I don't think that there's an advantage to be had by picking individual stocks in that sector. And there are a lot of sectors like that. Cybersecurity, AI, EV technology. I think there's a huge advantage to be had by picking individual stocks in those sectors. Even in the realm of fintech, you may be better off just going with an ETF that focuses on new fintechs. When it comes to like lithium battery supply chain, I think you're probably better off just focusing on an ETF in that respect. When it comes to individual companies in the EV space, I don't see why you wouldn't own Tesla, even especially at these prices. Let's talk about that for a moment. What's going on with Tesla right now is things that don't really look great. Meaning this could be the quarter of doom for Tesla. And somebody else said that the other day, and I don't remember who it was. But this could be the quarter of doom for Tesla. where you have Gigafactory Texas hemorrhaging money. You have Giga Berlin hemorrhaging money at this point. In fact, Elon Musk just said they're like furnaces burning cash. You also have weeks and weeks and weeks of disruption of production at Gigafactory Shanghai over this last quarter. And you have an impairment probably of $500 million or so because of the $1.5 billion, at least $500 million, because of the $1.5 billion of Bitcoin that Tesla bought. So you have that impairment with all of the other negative news. It is going to cut into profits this quarter. They're probably not going to have an earnings beat, and there's probably going to be a negative effect on stocks. All of these problems are just temporary, though. And I think that it's going to be very hard for me not to buy more Tesla, even though I'm overbalanced in Tesla. They occupy way too much of my portfolio, my personal net worth. It's going to be very hard for me not to buy Tesla in the run up to the next earnings because I know it's not going to be great. And the problem is with Tesla, with a growth stock like this, not great, which doesn't mean bad by any means, is going to be perceived as a disaster in many ways. But this may be the final opportunity to get into Tesla at anywhere near fair valuation until it actually sort of hits the top of its growth cycle 20 years from now, right? I really think that this may be the final opportunity that you have to get into this stock at under, I think we could see some bad news. You may end up getting into it in the 620s, 630s. And I think that's the final opportunity to do that because the split comes after that. We're going to see normalization of supply chains. We're going to see reopening of economies. At some point, the war in Ukraine ends. I don't know how much that affects their operations at this point, but it's really about the United States and China. And we see a normalization of supply chain here. And we see Tesla doing a better and better job of actually securing every single part of what they need in their entire supply chain from the ground up, from literally the ground, extracting lithium out of the ground to getting it into batteries to building. We see them doing a very good job of securing all of that for themselves, right? And a very good job of sourcing other companies to produce batteries for them. It looks like BYD might be providing them with lithium iron phosphate batteries, possibly the Blade battery itself, which I think is pretty amazing. Which means that the bet that Warren Buffett made in 2008 that BYD was all about the batteries, not about the cars. It was all about the batteries. That's the reason they made the bet. That bet would have taken a long time to come to fruition, but it finally is. So, Daniel here. Daniel asks, what do you think about Palantir? So you can go back to some of my early videos on Palantir where I just kind of outlined what they did. And I talked about and a lot. So I worked in the defense space for a long time as a contractor and as a technology contractor, and on the financial end as well. And so I'm familiar with government contracting. I'm familiar with needs of the services to a degree of the different agencies. And I was never impressed with Palantir like a lot of other folks were. And I was kind of trying to do this in a roundabout way, which is sound the warning on Palantir here that I don't see what's so special about them, especially in light of the fact that I finally got access to their software. It's fairly unique in terms of the way it helps you visualize things, but honestly, there are a lot of companies out there doing the same thing. Like Big Bear AI does a lot of those things. Splunk, I'm not a huge fan of Splunk, but they're one of the major competitors. None of them do exactly the same thing, but you're looking at Snowflake doing that. You're looking at Amazon Web Services. They're competing with Amazon Web Services, which is one of those, which is one of the big deals out there. They're competing with Dell's, with Dell's cloud services too. That's something you guys probably have not heard a ton about. They're competing with a lot of other cybersecurity companies, a lot of other AI companies, and Palantir's software is really a visualization tool to a large degree, right? Where a lot of the data analytics stuff that's being done by outside contractors. And what Palantir software really is a visualization tool, and it helps you build associations across disparate data sets that aren't necessarily connected. There are a lot of companies that are doing that. And there are a lot of companies that are growing really quickly. And none of them do exactly the same thing that Palantir does, but not everyone needs exactly what Palantir is doing either. And I think that they can't live forever off of the unconfirmed mistake that they may have been responsible for finding Bin Laden. I actually tend to really doubt that story after some of the things that I've read in terms of the intelligence work that went into that. I kind of doubt that story now, and I think it was, I think there were other things that are going on. So, what market cap would you assign Quantumscape? Currently at 4 billion. Man, every time I say something negative about Quantumscape, I get nasty emails from people. Just like there's Elon bros out there are Quantumscape bros that are out there as well. And honestly, I don't put a value on Quantumscape. Quantumscape is not really going to have a product produced at volume until at least 2027. So there's no hope of them making a profit before 2027, 2028, at least a real one. They may do like kind of a Li Auto profit where they're profitable by limiting their future prospects to a degree. And it kind of looks okay on paper, but it's kind of concerning about how much they're going to grow. Quantumscape is in that position right now. So I need to actually go back and look and see if there's anything white paper wise or academic publications wise that would make me think that their technology is closer to volume production than it was a year ago, the last time I really took a hard look at them. But I looked at the price recently, and it was I think it was under $10 a share when I looked at it. And I know I said last year that under $20 a share I might consider it. I'm still not considering it. So Quantumscape is one of those companies where, in principle, the idea sounds great. I can't find evidence that their technology is going to work the way they say it's going to work. It has a lot of issues when it comes to longevity and I mean basically how many cycles. You're looking at most of their technology. When you look at it in lab tests, they're saying the best it's going to get is 200 cycles, right? So I need to see evidence, like actual like lab tested evidence, or maybe it's out there and I just haven't seen it. I don't know. But at this point right now, I'm not convinced that this isn't vaporware to a degree, right? So, and there are a number of companies in that battery space that were really hot in 2020 and 2021, where I'm beginning to believe that is the case now, that a lot of these companies are vaporware. A company that I haven't looked at for a while that I'm surprised is still around is, of course, Nikola. They are, let's see where they're trading today. Nikola Corporation, or Nikola. However, people make fun of me for saying it the way I say it all the time. All right, not sure why here. So I'm surprised it's trading for this much. This is still a company that doesn't have products. It's got a few things in test market right now. And they have a few vehicles that are at market, or that are being tested in Europe, that have actually been delivered to clients, that are being tested by clients. But none of the claims that they have worked out there. I haven't seen anything technical on whether or not they're going with a renewable natural gas and battery electric solution in Europe, or whether it's the the hydrogen fuel cell battery electric vehicle. I'm a really big fan of hydrogen fuel cell technology. I just see a ton of challenges. Okay, so I'm looking at Quantumscape here. Quantumscape still at 947. Even that is, I think, overpriced. This is Quantumscape is essentially a science project at this point. It's not a company, right? Yeah, not sure why my internet connection is so slow when I'm looking at these right now, but it is. We've seen a rather precipitous decline. I know it was over $100 a share last year at one point. I looked at it when that was just ridiculous. But yeah, so their losses have narrowed. That's a good thing. They're only losing 55 cents per share. That's a good thing. But yeah, unfortunately, right now I'm not able to pull up a ton more information on them for some reason. Yeah. So back to Barron's here, though. When I see things like the numbers show why the sell-off might not be over, a shocking number of stocks are in the red, companies are borrowing less, why Wall Street's estimates are a problem, earnings shortfall. It's bad news for stocks. Um, these are all signs to me that we're really close to capitulation, guys. I actually kind of hate to say that. I hate to make that prediction, but I do think that between now and the end of August, the investments that you make are going to be your best performing investments for the next like 5 to 10 years. And like I said, we're really close, especially if retail investors are really bailing pretty hardcore at this point. We're pretty close to capitulation. Anyway, folks, I got to cut this one a little short today. I have to hit the road here in just a bit. I got some stuff to do. Thank you guys for tuning in. I will see you again on Monday. I'm also going to come out with some more research videos next week. And next week, Monday through Thursday, I'm going to be doing a live stream. But yeah, I do need to cut this one a little bit short today. Thank you very much for tuning in, and I will see you next time.